Ask you your name. Name is Akshay. Monday and Wednesday. It doesn't know what to sit next to you. So Peter, right? Come on. Yeah. Talk up. Let's talk up to him. Okay, folks. So I'm going to ask at the start of every class, by the time I get to the end of Monday and Wednesday, my voice is getting a little frayed, so I don't want to lose my voice entirely. So if you guys could quiet down a little bit, you can hear me. At the start of every class, for the next 4 sessions, I'm going to ask 2 questions. Okay. And then I'm going to stop. Here's the first question. How many of you have picked a company to value for your project? How many of you picked? I'm going to look around, right? Most of you haven't. This question is, is going to get reframed next week. Next week, when I ask this question, I'm going to ask you how many of you have not picked your company, because by then, hopefully, most of you have transitioned. Second question, if you picked your company, did you remember, you don't have to answer this, did you remember to go put your company name down on the master list? Somebody had actually tried to fill out the rest of the master list. For the moment, all I need is your company. You don't put a DCF valuation. If you've done that, you don't need the rest of the class. Obviously, you got it all nailed down. So all I need for the moment is the name of your company with the right to change it, right? So I'm not going to hold you to it. I just want you to pick a damn company and start moving on this, because otherwise you're going to go back and forth until week 8 before you pick a company. So today we're going to start on the meat and potatoes part of valuation. We're going to start talking about the inputs come up with discount rates, especially risk-free rates. Okay. So I'm going to start with the start of the class test, like I always do, and this is going to revolve around risk-free rates. I want to pick somebody from Brazil to be my guinea pig. There must be somebody in this class from Brazil, right? Oh, there you go. Okay. So the rest of you can go along. There's no Brazil specific experience you need to answer this question. I just want to pick on a Brazilian for the moment. So let's say you're valuing a Brazilian company, okay? And you're trying to pick a currency to do the valuation in. You can value it in reais or you can value it in US dollars. And I give you the risk-free rate. Today we'll talk about how to get risk-free rates in reais and US dollars. You might say it's obvious, but let's see. Let's say the risk-free rate in reais is 7.5%, and the risk-free rate in US dollars is 2.5%. You ready? You're on the stage now. I can value this company in reais with a 7.5% risk-free rate, or I can value the same company in dollars with a 2.5% risk-free rate. Which currency choice is going to give you the higher value? Doesn't matter. That's actually the right answer. Tell me why it doesn't matter. Because, I mean, let me play devil's advocate. Which one's going to give you a higher discount rate? You start with the risk-free rate of 7.5 or 2.5. Which one's going to give you a higher discount rate? Come on, don't think too long. You start with a higher number, you're going to end up with a higher discount rate, right? So the discount rate in reais is going to be higher than the discount. And I thought in discounted cash flow valuation, the discount rate goes up the value should go down. So tell me what's happening where that's off. Something has to be happening to offset it. So what do you think is happening that's allowing this higher discount rate to get offset? You can stay on, you can try. Let's isolate that, right? The business is the business. So where does currency actually show up in the cash flows? What dimension does it affect? You're selling the same number of products to the same number of customers, the same business model. All I'm doing is switching currencies, right? Basic question I'm asking is why do risk-free rates vary across currencies? One of the things we're going to examine today. And whatever makes the discount rate, and I'm going to leave it mysterious at this moment, whatever makes your risk-free rate higher in a currency will also show up in your cash flows in an exactly proportionate manner. I'm going to leave whatever that is mysterious. And if you do this right, you will get the same value for your company, whether you value in US dollars, Brazilian reals, British pounds, euros. And this is incredibly good news. You know why? When you pick a company, pick a currency and just stay true to it. What gets people into trouble is going back and forth. You want to value a Russian company, Sophia is, you can value in rubles. God help you if you do go down that path. Or you can value it in euros or dollars. God help you that way too, right? So either way, but if you do it right, you'll get the same value. And I'll give you the analogy I want you to think about to understand why currency doesn't matter. What's the temperature today in New York? 60. Are you European? Oh, you're okay. Yeah. What's your temperature? You think in Fahrenheit, right? 32 is so much higher than 6. He must live in a hotter part of New York than he does, right? The only difference is you're talking Celsius and Fahrenheit. It's really like 40 degrees Fahrenheit or 42. Can you make a hot place colder by just stating the temperature in Celsius? I land up in Delhi in July of any year. It's going to be hot, whether I state the temperature in Fahrenheit or Celsius, because it's a measurement device. Currency is a measurement device. I can't make a great company into an awful company by switching currencies. And conversely, I can't take an awful currency and make it into a great currency. It requires a lot of gymnastics along the way. We'll talk about what you have to do to be careful that this holds. Let me follow up on that. So currency doesn't matter. Can I do a valuation with currency entirely out of the process? It's called real valuation. Real cash flows, not REI, but real. Real cash flows and real discount rates. What's a real discount rate? Real cash flows just reflect what you would make as a company if you could never raise prices. You have constant prices and you just have to grow, you have to sell more units. So cash flows are real cash flows. There's no inflation embedded. Your discount rate then has to also be a real discount rate, which will also have no inflation embedded. You're saying, where's inflation showing up in your risk-free rate? That again, we will try to make explicit today. There is a linkage there. Again, if you do this right, and I'm going to answer the question for you because it follows from the first one, doing everything in real terms, which is a 0% inflation in your cash flows and a 0% inflation in your discount rate, will give you the same value. You know what parts of the world people used to do things in real terms in? The near inflation rate is 5,000%. Do you ever want to do things in nominal terms? In Venezuela, so I'm going to use a 5,000%. God help you. You start with 5,000% and build up. The zeros on your Excel spreadsheet are going to start building up over time as well. So you can say, look, I'm going to take inflation entirely out of the picture. Inflation doesn't go away as a problem. You're just removing it from the exercise to make your exercise more manageable. So we'll talk more about how inflation plays out in risk-free rates, but that's going to be the starting point. Let's keep going. The US T-bond rate is often used as the risk-free rate in US dollars. We'll talk about whether that's okay, right? We spent a decade with abnormally low T-bond rates. During the last decade, the average T-bond rate was about 2.5%. Just to give you perspective, it was 6.5% in the 80s, 5% in the 90s, 4.5% in the first decade, but last decade it was down to about 2.5%. If you listen to a lot of CNBC, which is a bad mistake, I would break that habit quickly, and ask you why were risk-free rates low in the last decade, the answer you usually get is the Fed kept it low. Doing what? QE1, QE2, Titanic, quantitative easing, all kinds of buzzy words come out. But the Fed keeps rates low. And this is a fixation. Every time the Fed Open Market Committee meets, all of CNBC comes to a standstill. It's like a pope being elected. What's the smoke going to say? Gray smoke, the rates are going up. It's amazing how the whole world has become this waiting place for what will the Fed do. So we're going to start to break some of these bad practices right now. Do you think the Fed has been what's keeping rates low for the last decade? You're saying no, but no, why not? No, because I hear from CNBC all the time about Fed keeping rates low, that it's going to raise rates. What's the only rate the Fed sets? You know, overnight. It's an overnight interbank borrowing rate called the Fed funds rate. When was the last time you borrowed at the Fed funds rate? I tried. Actually, the Federal Reserve, you can have this little tour. It's actually a neat tour. They take you around the Fed. The best part is they take you down to the basement to the mint, and you can see the currency. Don't try anything rash. It's well protected. I tried, said, can you show me the Fed funds window? I'd like to borrow money. And the nice lady was taking on the tour, said, no, you can't borrow at that rate. It's the only rate they said. Can they influence interest rates? Yes, but they don't set rates. The rates we're talking about are either market set, like the T-bond rates, or driven by market rates, like your mortgage rate. In fact, what did the Fed do last September? Cut rates. I read that headline, Fed cuts rates. You know what happened to interest rates for the rest of the year? They all went up. So we're going to get to the heart of the Fed delusion and how I think it's getting in the way of us thinking sensibly about interest rates. This fixation with the Federal Open Market Committee meeting and deciding has to go. It's actually getting in the way of sensible thinking about what is it that drives interest rates. Which leaves you with a final issue with risk-free rates that's been driving people a little crazy for the last decade. The last few years, there have been at least a couple of currencies where the risk-free rate has turned negative. And this freaks people out. Why? Because in your econ classes, you never saw this coming, right? It's supposed to be a rate for current consumption versus future, and it's always a positive number in class, and here it is negative. Swiss franc, Japanese yen. When risk-free rates turn negative, I've heard people say you cannot do valuation anymore. You can see how the logic works, right? The risk-free rate turns negative, your discount rate is going to become really low. When your discount rate becomes really low, your valuations are going to explode. I think the reason they won't is the answer given to the Brazilian real question. We'll talk about where in the process or what the messages you're getting from negative risk-free rates. And trust me, it's not an uplifting message about the future. You don't want to live in a world with negative risk-free rates because the signals you're getting about what the future will deliver. And I've seen people in this case actually replace the rate today with a normalized rate. You're saying, what's a normalized rate? Who the heck knows? So what do? You take the last 40 years, you average the rate over the last 40. It said that I tell people, you tell me how old you are, I'll tell you what your normal is going to look like. Because you're really old, you're going back to the 1980s, right? You're not that old, you might go back 20 years. If you're really young, you might go back 5 years. And guess what? Your normal rates are all over the place. Terrible practice, but we'll talk about what drove people to that practice and why it's a dangerous practice. A lot on our plate. We have to talk about why risk-free rates vary across currencies. We have to talk about how to get to real risk-free rates and also talk about what central banks do in this process that might or might not affect rates. So let's go back to where I left you on Wednesday. We were talking about, you don't even remember, right? There was a last week. We had class last week. We did a lot of stuff in the class. It's kind of gone by. But we talked about cash flows to equity and cash flows to the firm. We talked about consistency. Cash flows to equity, you discount the cost of equity. Cash flow to the firm, you discount the cost of capital. If you discount cash flows to the firm at the cost of capital, you get the value of the entire business. But let's say you're interested in just the equity because that's what you're going to buy shares in. So my first question, and this is directed at those of you who worked in banking last summer and did this, mechanically, is what do you subtract out from the value of the firm to get to value of equity? And I'll give you the choices. You can subtract out the value of just long-term debt. You can subtract the value of all debt, which includes short-term debt as well. You can subtract the value of any debt that you call debt in your cost of capital calculation. Or you can just go crazy and subtract out all liabilities, current liabilities, all the rest of the stuff, saying they're all liabilities on my balance sheet. Which of these choices should be off the table right off? D. Take that out, right? That's a bludgeon. It's not going to work. The question is, which of the first three? You want to try? What do you think I should subtract out? Okay, that's good. Did you use that in your cost of capital as well? If you're going to, why would you use two sets of rules? And why are you subtracting all debt when you do this and not do all debt when you do cost of capital? Fine, you can have it in both places, right? So I can understand the logic for all debt, but why just stop there? My question is, why isn't C doing what B would have done anyway, right? Because if you do this right, shouldn't debt be debt in both places? Which shouldn't be.
Well, B and C should.
Not necessarily, right? Let's take an example. Before 2019, accountants didn't treat leases as debt, right? So now they do, but let's suppose pre-2019. So when I did cost of capital pre-2019, I did this. I treated lease as debt, brought it in as debt in my cost of capital. We'll talk about the mechanics of doing it. But then when I got to the end, I had to subtract out my debt number, not the debt number you see in a balance sheet. You see, the reason you have to match up the two is if you don't, you have two stories in your valuation that are not quite synced. The reason I threw the long-term debt in there, for some reason, there are bankers who seem to think only long-term debt is debt. I don't think they've ever borrowed money. I think they need to borrow money from a money lender, preferably, because the lessons will, I think, get reinforced more. You borrow money for 2 weeks from a money lender, you don't pay your debt. You say, it's just short-term debt. You know what's going to happen? You're going to have two broken knees. And then you will remember that all debt is debt, short-term as well as long-term. So this is a stupid debt, short-term or long-term. We'll talk about why we don't bring current liabilities into debt. And it's a very mechanical reason. But ultimately, you tell me what debt you have in your cost of capital, that's going to be the debt you subtract out. And if you do that, should you get the same value for equity that you got by taking cash flows to equity and discounting at the cost of equity? Let me reframe the question. Would you like to get the same value? I would, because then you imagine being an equity research analyst today, by using equity valuation models, sell using a firm valuation, you won't be an equity research analyst for very long. So let's try whether to see if they get, and this is a made up example, and it's a made up example where I made implicit assumptions that are going to lead me to my finding. So here I have a business, I have cash flows to equity. Those are the cash flows after debt payments. I've added the only debt payment here. Let's assume it's only interest expenses, and I've got a cash flow to the firm. I've got a cost of equity of 13.625%, and I can borrow long-term at 10%. There's a pre-tax cost of borrowing. The company has a market value of equity of 1,073 million, and you should already be a little suspicious because the numbers look a little too third decimal, four decimal-ish, and there's a reason for that in a moment you're going to see. But I've given you all the information to both value the company based on equity as well as firm. Let's first try discounting cash flows to equity, the cost of equity. So I take each cash flow, and these should be raised to the power. I'm sorry, for some reason that so the two should be raised to the power. So I take the first year's cash flow, discount back 1 year, second year's cash flow, discount back 2 years, and you add up the present values, the value that you get for the equity, discounting cash flow to equity at the cost of equity is 1,073 million. The company is fairly valued. But if I take the cash flow to the firm and discount it back at the cost of capital, which is a weighted average of my cost of equity and my cost of debt. And remember, debt brings a tax advantage, so the 10% rate becomes a 5% rate. What I get as a present value is 1,873 million. And what do? I subtract out the debt, 800 million, and voila, got magic. I get exactly, I've cheated along the way. You didn't see where I cheated, but I ended up with the same answer for my equity. Either way. There was a weekly challenge I gave you last week, which I don't think any of you would have tried. I wouldn't want you to try that weekly challenge today when you get a chance, because it's an exercise and What happens when you do this in a real firm? Because you actually will get different answers for the equity. And I'm going to ask you, what is it that we're doing that's causing the values of equity? It's one of the most difficult exercises in valuation. It's unfair to throw it at you right at the start of the class. But it's good to start wrestling with the implicit assumptions we make when you do valuation. So the bottom line when you value companies is make a choice first. The same thing with currency and stick with that. If you want to value equity, make everything about equity. If you want to value the firm, make everything about the firm. There are so many different ways you can screw up. So let me establish the first consistency principle. And there are going to be other consistency principles that come in. When you discount cash flows, you tell me how you estimate the cash flows. I'll tell you the discount rate that goes with it. If your cash flows are after debt payments, I use cost of equity. Cash flows to the firm, I use cost of capital. Mixing and matching cash flows is an absolute disaster. Remember the Kennecott. You can get every cash flow right, but if you use the wrong discount rate, all that work is down the drain. Put a big X on this page because when you're doing your quiz, you might get a little flustered and start reading off the wrong page. Okay? These are things you shouldn't do. So if you take cash flows to equity and discounted the cost of capital, you will overstate the value of equity, which is what First Boston did with carborundum because they discounted cash flows. If you take cash flows of firm and discounted the cost of equity, it'll go the other direction. You will undervalue the equity. And if you discount cash flows firm at the cost of equity and forget to subtract our debt, God help you. I don't even know what you ended up with. Just because you have a D and a CF doesn't mean you have a discounted cash flow valuation. So the next time you see a you have the tools now at least to take it apart. What's the cash flow? What's the discount rate? Do they match up? If they don't, the rest of the valuation is moot. It doesn't really matter. So what I'd like to do actually is set up intrinsic valuation, the pieces that go in. I'm going to show you a big picture page of what the different pieces are. And then I'm going to talk about three different ways a DCF can be structured. Two are equity ways, and the third is the firm. So you look at discounted cash flow valuation. Here are the ingredients. You have cash flows. Those cash flows can be either before debt or after debt. If they're before debt, they're cash flows of firm. If they're after debt, they're cash flows to equity. Your discount rate can either be to the entire firm, cost of capital, or it can be just to equity, which is the cost of equity. And even your growth rate can be different because when I ask about growth in equity cash flows, you're focused on equity investors. You care about equity income, net income, earnings per share. But if you're looking at the entire firm, the growth rate you have to be talking about is growth in operating income, which is before interest expenses. Already you can see every question you ask is framed by the choice you made up front. If it's equity, everything stays in equity terms. It's a firm, everything gets stated in firm terms. So I'm going to start with the simplest discounted cash flow model around. This is the model that's been around almost 100 years. It's called the dividend discount model. It comes with consequences because you're assuming companies going to pay out what they can afford to. And I'm going to value a company based on dividends. And when you do that, you can basically see that I'm focused on what companies pay, which in the case of Google is what? Just started paying dividends. If it's NVIDIA, how much is NVIDIA paying dividends? Make a guess. Nothing. They pay zero dividends. I wish I were 100%. So if I did a dividend discount model value of NVIDIA, what might I get? That it's worth nothing. Now we can debate how much NVIDIA is worth, but it's definitely worth more than nothing. Right? But in the dividend discount model, you keep your eyes on dividends. Your growth rate is growth in equity income and dividends. Your discount rate is a cost of equity because dividend is an equity cash flow. And what you get as a present value will be the value of equity in the company. So that's a dividend discount. If I'm doing dividends, so I'm assuming companies are paying out what they can afford to in dividends. Do companies pay out what they can afford to in dividends? How do we know that they don't? There is conclusive proof on the balance sheet that Apple doesn't pay out what it can afford to in dividends. What gives it away? Wrong side of the balance sheet, though, because you might be paying exactly what you should, and your retained earnings can still be great. Now, Coca-Cola pays roughly what it can afford to. Its retained earnings are huge. Go to the other side of the balance sheet. There's an item. Look at their cash balance. How much cash does Apple have? Almost 200 billion. How did it get there? Not manna from heaven. It's a direct consequence of the company not paying out what it can afford to. So if I do a dividend discount model valuation of Apple, I am going to undervalue the company. Why? Because I'm not counting out the cash flows they could have paid out. So how the heck do I know that? Can I estimate how much they could have paid out? We're going to talk about a process. As I said, this is the big picture. We're not there yet. Of estimating these potential dividends. I'm going to call it free cash flow equity. It's a fancy word for potential dividend. It's what's left over after every other need has been met. So if I don't like dividends, if I look at a company like Apple and say, hey, dividends are not a realistic measure of what equity investors get, I can focus on free cash flow equity. The growth rate then will be in equity income and free cash flow equity. Your discount rate is still a cost of equity, free cash flow equity. And what you get as a present value will be the value of equity in the companies when you close the process. And let's do the final leg. I could look at cash flows before debt payments. To get to cash flows before debt payments, I have to start with operating income. Net income is already after interest expense, so I've got to climb the income statement. But this cash flow will be before debt payment, before interest and principal payments. Again, we'll come back and talk about the specifics of capex and depreciation, working capital, all that neat stuff. But we're estimating cash flows before debt payments. If that's the cash flow I'm discounting, the growth I should be talking about is growth in operating income and free cash flow to the firm. The discount rate has to be a cost of capital. And I can shut this process, and I'll talk about the significance of shutting the process down when your free cash flows start to grow at a constant rate. Do you see what they are? I mean, you could put them next to each other. You can see already they're trying to do the same thing. The only difference is how you define cash flows and the discount rate that goes. So if you ever get confused, FCFE, FCFF, dividend, look at this table because it kind of shows what they have in common and what makes them different. So if you're doing a dividend discount model, here's how it'll look like once you're done. You're going to project out expected dividends next year. To do that, you'll have to first project out earnings growth and what they will pay out as a percentage of earnings. Two inputs, growth and payout ratio. You get expected dividends. And you'll discount those dividends back at a cost of equity, reflecting the risk of the equity. For the moment, again, all these things, you say, I don't know what a payout ratio is, what a beta is, we'll come back and nail them down, but everything is focused on dividends. One of the reasons I talked about cash flows growing at a constant rate forever is you can't keep doing this forever. To stop at some point in time, right? You run out of columns in Excel. What, 16,484? You run out of patience about 16,474 columns earlier. So in all of discounted cash flow valuation, there's a closure point where you stop and you estimate what's called a terminal value. What does the terminal value do? It captures the present value of all cash flows beyond that point in time. It's the most dangerous number in valuation because this is where you get yourself into trouble. We're going to spend a lot of time on that. But everything in a dividend discount model is built around expected dividends. If you look at a free cash flow to equity model, it looks exactly the same. The only difference is you're replacing dividends with this potential dividend. You're still going through the process of what will it grow at, when will it become stable, and then you discount back at the cost of equity. What you get as a present value will be the value of equity in a company. I know I'm belaboring these big pictures, but I want you to compare them to each other because I want you to see what they have in common as much as what they have in differences. You're doing the same thing. They're all discounted cash flow models. It's only how you estimate cash flows and what discount rate you apply. And finally, if you look at free cash flow, the firm models, you replace free cash flow equity, the pre-debt cash flows, the cost of capital. Your growth rate becomes a growth in operating income. So you look at what drives that. Your discount rate becomes the cost of capital. And what you get as a present value is the value of the operating assets of the company. Why operating assets? Because you valued only those assets whose income is part of operating income. I don't want to be mysterious. In the case of Apple, what have I not valued yet when I discount free cash flow to the firm at the cost of capital? It's a big I just mentioned it. What's a big asset they have that whose income is not part of operating income? Cash. Income from cash is not part of operating income. This is where if your accounting is a little soft, I'll leave it at that word, you will have trouble. We say, really, interest income is not part of operating income. It shows up below the operating income line. It shows up as part of net income. So you know what that means, right? If I discount free cash flow firm at the cost of capital for Apple, I haven't valued $200 billion. This isn't penny change. You can't just leave it away. You got to add it in. We'll talk about the dark side of cross holdings and what they do for companies, and I'll leave that at that. But there's a lot of mopping up to do. I'm going to call these loose ends to get from the value of the firm to value of equity, and we'll spend 2 sessions on just these loose ends. Dividend discount model, free cash flow to equity, free cash flow to the firm. They all try to do the same thing, which is discounted cash flow valuation. And this is why I'm always wary when somebody says, I do DCF. I've done a DCF of a company. You haven't told me anything. What cash flows do you use? What discount rate do you use? Because until you give me those specifics, I'm not even sure what a DCF even means. So now let's talk about process. How many, only a few of you have picked a company. You can start this process this evening. So what's your mission? You said you picked a company, right? What's your mission? You value this company, right? So what do you have to do? You have to forecast the future. Where are you going to start this process? Common sense, you start with the past. You say, what if I don't have much of a past? Well, that's all you can take. Take what you can get. If you have a young company, it might be 2 years. If you have an old company, it could be 150 years. You start with the past. So the game always starts by looking at the past. I'm going to try to see if I can. So it starts with the past. So when you're looking at the past, and this is a general question, you take your company, let's say you picked a company, you looked at the last 5 years, last 10 years. What are you looking for? What are some of the things you're trying to get rid of that? Here's the first thing. Don't get caught in the details because you're going to get so lost in the details that you will not be able to get your head above water. You know what I mean by that? Accounting classes, they ask you to compute all these ratios, and before you know it, you got 200 different ratios computed for your company. Amazing job, but you have no idea why you even computed them. There are 3 core questions you're trying to get a sense of by looking at the past. First is, how quickly is my company growing? See why this matters, right? If you're going to tell a story about a company, and your company's been growing at 2% a year for the last 10 years, you have to be a little skeptical about saying, I'll grow 20% a year for the next 10. So you're going to look at past growth. And the metric which you should focus on to look at growth is revenues. Because revenues don't lie. Income does. So you can do accounting games and increase your earnings. So I'm going to look at revenue growth. Again, to get a sense of how, doesn't mean the past is prologue, right? So just because you have a high revenue growth company for the last 10 years doesn't mean it's going to be high in the future, but at least you have a starting point. But growth alone doesn't make you valuable, right? As you grow, what do you have to do? Make money. So the second stop you're going to make is, how profitable has my company been in the past? Anybody willing to put up their accounting? Jennifer, you want to be my accounting guinea pig? When you look at an income statement, you can compute all kinds of profit margins. You know what profit margin is, right? You take a profit, divide by revenues. There are 3 big margin numbers you can get out of an income statement. There's gross margin, there's operating margin, there's net margin. So Jennifer, help me out. What is gross margin measure? No, take any year. So when I look at any year, so let's say, because next year I don't have the numbers. So let's say I look at 2024 numbers. So Tyler's going to jump in and I'll come back to you. So Tyler, what is gross margin measure? Revenue minus COGS. And this is the problem when we get into accounting acronyms, is we say, what the heck is COGS? What the heck is COGS? But no, what does it measure? That's not necessarily true. Gross margin basically measures unit economics. It measures the cost of the stuff you sold. So if you are a software company, it's the cost of making the cost of making that extra software unit, which is close to 0, right? So if you get an Microsoft and you order another copy of Office 365, there isn't a little, whatever person at Microsoft writing and saying, I've got to make another copy. So the cost of goods sold is going to be tiny at Microsoft, because whereas if you're a manufacturing company, even the most efficient one, it's unit economics. Unit economics basically measures how much money do you make on the next unit you sell. You're saying, I'd like that number to be high. We all do, but you pick a business, it comes with unit economics. So gross margin measures unit economics. Operating margin, what do? You take the gross profits and then you subtract out things like R&D and G&A, which are not directly related to the next unit that you sell, but you have to do to operate as a company. So when you look at operating margins, you're getting a sense of economies of scale. I want you to stop thinking about these words as buzzwords, because every company claims to have economies of scale. Every company says they have great unit economics. Check the numbers. If they have great unit economics, their gross margins have to be high. If they have big economies of scale, here's what's going to should happen. As the company grows, its operating margin should increase, right? Because it's costs. That's what economies of scale means. Your costs are growing at a lower rate than revenue. So you're looking at gross margin as a measure of unit economics. Operating, we'll come back and kind of nail this down more with actual companies. Operating margin measures what is net margin? What causes the operating margin to diverge from net margin? Primarily how much debt you use. You know what the gross margin for NVIDIA was in the last 12 months? Close to 80%. Why? I mean, it's a semiconductor chip company, doesn't it? So what does it tell you about the company? They design chips. They don't make the chips. TSMC makes the chips for them. They mark them up immensely. Why? Because everybody wants AI chips. Their gross margins are 80%. Those are nosebleed margins. I mean, those might be higher than those might be the highest margins the S&P 500. You know their operating margin is? It's close to 70%. Now do you see why the company's worth 3 trillion? It's not just that they've grown, but it's a money machine. Will it stay a money machine? That's what your valuation is going to try to answer is. So you're just looking at the past year to get clues. You look at revenue growth, you look at margins, and then you look to answer a final question. To grow, what did they have to do? How much did they have to invest? So if you're a manufacturing company, I'm looking to see how many factories you had to build. You're saying, why does that matter? Because that growth now has to be offset against what you reinvested. I'm measuring how efficiently you delivered the growth. And if you're a company that got a lot of growth with very little reinvestment, I'm going to reward you more because that's a great business model. But if you're a cruise line company and you keep buying these cruise ships every year, you can show me you're growing 30%. But I'm not going to be that impressed. Growth, profitability, efficiency of growth. That's what you're trying to get clues to by looking at the past. So let's say you look at the last 5 years, you get some clues in your company. It's a moderate growth company with decent margins. It's reinvested, not incredibly, but reasonably well. It's all coming from the past, right? This is where you got to leave your comfort zone because what's your job in valuation? Is to look to see what this will look like in the future. And your first reaction is going to be, I don't know. Fight through that moment because none of us does. You have to make your best estimate. You could take the lazy way out, which is what a lot of bankers and analysts do, which is, I don't know. So here's what I'm going to do. I'm going to just extrapolate the past. You take the revenue growth in the last 10 years, you applied for the next 10 years. You take the margin in the last 10 years, you applied for the next 10 years. You're saying, what can go wrong? What can go wrong? You're a Canadian lumber company, and I do this. Your entire business model changed today, right? What can go wrong is the world keeps shifting around you. DeepSeek comes around. Maybe NVIDIA's margins are not going to be as strong. Thank God those things happen. So you think that's weird. Why would you want something like that? Because if all I had to do was extrapolate the past to value a company, I don't need you, right? Or a person. ChatGPT could go do it for you. Some AI engine can do that for you. You can automate the entire. Thank God things happen that change those historical pathways, because that's where you will come in with the evaluation. So what we're going to do then is to forecast the future. And here, I'm going to give you two pathways. One is the most general pathway, and I'll define how we're going to value companies. You're going to project the revenue growth in the future. We'll look at the factors that play into whether you can continue the past, whether you got to break from the past, lower, higher. Then you're going to project margins in the future, right? And they can go up. Which in the case of NVIDIA, it's tough because you're already at the top. But if you're valuing a company with very low margins, say they're going to cut costs, margins can change. And finally, I'm going to ask you, how much will you have to reinvest to get that revenue growth? Revenue growth, margins, reinvestment. Keep it simple. Those are ultimately the three drivers of your cash flows. We can dance around those, break them down into 500 line items, but ultimately that's what's going to give you cash flows. So that's a general approach to forecasting free cash flow. There's a special case, and I'll talk about the special case, not because there are that many of the special case, but it's going to help us in the closure part. If you have a company with stable margins and stable returns on capital, what kind of company would that be? Let's say Con Ed. What does Con Ed do? Supplies the parts, a utility, it's regulated utility, it's been around forever. And if you assume that that regulated monopoly is going to stay, and you say the margins are pretty much set, their returns are pretty much set, I'm going to give you an easy way out in forecasting cash flows. Rather than forecast the growth in revenues, I'm going to ask you to forecast two other numbers. One is a reinvestment rate, the percentage of your after-tax operating income that you put back into the business. So if you have revenues of after-tax operating income of 100 million, you put back 40 million into plant and equipment and machinery and whatever else. That's a 40% reinvestment rate, and a return on capital, which is what you can make on your projects. Again, you say, I have no idea. You can look at the past, but you have to make that judgment in the future. Your reinvestment rate times your return on capital will give you the growth rate. You don't have to estimate growth rate, but that's only if margins are stable. So the reason I'm laying that out is later on, we're going to talk about when you can take that path in your company. But until you get there, you got to do revenues, margins, reinvestment. And in discounting all of this, what do you need? A cost of capital. I'm afraid we've already ruined you in finance classes, because if I ask you to talk about risk and cost of capital, we've already drummed in beta, standard deviation. I want to step back and give you the intuitive feel for what you're trying to estimate. To get a cost of capital, I need a cost of equity and I need a cost of debt. Everybody agree? Two numbers. Let's start with the easier number first. What goes into a cost of debt? You're a banker, you're lending money to me in US dollars. Let's keep the currency up. You're going to see why currency matters. How are you going to decide what interest rate to charge? What are you going to start with as your base? Yes. Which in the US, because I'm doing it in US dollars, and this is why currency matters, is going to be, let's say, the T-bond rate. Right now, it's about 4.55%, 4.6%. Would you lend money to me at the risk-free rate? If you did, how long would you last as a banker? Not very long. Why? Because I could default. So what do? You add a spread on top of the risk-free rate, right? Again, don't let the buzzwords get in. You're going to add a spread, and the Rothschilds in the 1500s probably had to do it as well, which reflects the risk you see in my company: credit risk, default risk. Risk-free rate plus a default spread is going to give me my cost of debt. And then the government steps in and says, you borrowed money. That's amazing. We'll help you out by doing what? When you borrow money, what is the advantage you get, which you don't get when you have equity? You get a tax reduction. How many of you do your own taxes? You don't have income, you don't have taxes. So, but soon you'll be doing your own taxes. Somebody will be doing your taxes. If you're doing your taxes, you have interest expenses? No. Okay. So you're not there yet, but at some point in time, you'll be wealthy enough for interest expenses. You know what? You're allowed to claim your interest expenses as a tax deduction, which effectively makes the cost of debt lower, because when you borrow money at 8% and I give you a 30% tax rate benefit, you're effectively borrowing money at 5.6%. You see how I got from the 8 to the 5.6? 8% times 1 minus the tax rate. That's the cost of debt. That's the easy part. What's the cost of equity? It's a number you had in your heads when you bought my shares. This is going to be a nightmare to estimate. Why? Because I'm going to be able to read your minds. Assume I can. Don't worry, I cannot. So if you're thinking about something else to say, let's say I went around reading each of your minds. What's the next problem I'm going to face? Did you all have the same number in your minds? No. Each of you might have a different number. And I have to come up with one cost of equity. For 50 years, probably 70 years in finance, we've wrestled with how do you come up with one cost of equity in NVIDIA when you have all these thousands of people own shares. And you know how we got through and solved that? Does anybody else own shares in NVIDIA besides me? Okay, good. What's in our minds doesn't really matter. Why? We don't own enough shares. I took a look at the top 10 shareholders in NVIDIA. You know the largest shareholders? Vanguard owns 8.5% of the shares in NVIDIA. 8.5% of the shares. Big institutional investors. And that gives me an escape hatch because now I'm going to say, look, it's not all shareholders I care about. It's the marginal shareholders. Who are the marginal shareholders? They're the shareholders who own a lot of shares and trade those shares. Vanguard, BlackRock. I look down the list, State Street. Now, what's in Vanguard's portfolio? Everything. Everything is in there, right? They service pension funds, but you think of what they hold every single stock in the market. So when they think about the risk in NVIDIA, it's a risk that they add on to their portfolio. This is the breakthrough that gave rise to finance as a discipline. Harry Markowitz walking in to that library in Princeton saying, the risk of a stock is not based on how much it moves, but how much risk it adds to a portfolio. The rest is pure mechanics. So when you talk about betas, it builds on the presumption that the risk in a stock is the risk added to a portfolio, right? We'll talk about what if that assumption is wrong, because that assumption is wrong. None of this stuff works. But every risk and return model in finance is built on that presumption. So with that presumption that the cost of equity in a company is going to be estimated based, so you're looking through the eyes of Vanguard, not through your eyes or my eyes, because you got to be a price taker in this. You don't set the prices. Your cost of equity is going to come from assessing, and we'll talk about how to come up with the beta and the equity risk premium that you need, but effectively your end game is the cost of equity. So we're almost there. We got a cost of debt, we got a cost of equity with this gymnastics we did about with assumptions. We take a weighted average. Final rule in DCF is those weights have to be market value weights, as opposed to what? You come out of an accounting class where there's a shareholder's equity in a balance sheet. Never, ever, 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 ever should you use a shareholder's equity from a balance sheet as the equity when you do cost of capital, the weights. And we'll talk about why that rule is in place. But that's basically what a valuation is going to look like. So that's what you're going to be doing for the next 7, 8, 9 weeks is going through this process. But I want you to think about what this big picture is leading you. So let's talk now about the sequence here. And this is a sequence that works for me, work with whatever sequence. We're going to start by at least getting a sense of what the past looks like. Then we're going to talk about risk and discount rates. Because I've given you at least in generic terms of cost, how do we estimate the default risk in a company and come up with a default spread? How do we come up with a beta and an equity risk premium? How do we even come up with a risk-free rate that you need for both? So we're going to start with risk and discount rate. Second, we're going to come up with taking past numbers and projecting the past. And here the storytelling is going to kick in somewhere along the way because you are telling a story, either of a continuation of the past, which is the easy story, or a break from the past, a much more difficult story. Step 4, we're going to talk about applying that closure. You got to year 5 or 10, you're tired, you don't do this anymore. I'm going to give you an escape hatch, but it comes with all kinds of clauses of what you can or cannot do. And finally, I'm going to tie up loose ends, getting from the value of the firm to value of equity. So let's start with the first step in the process, the D in the discount rate. I'm going to start with a statement that's obvious. Does the D matter in a DCF? Yes, of course, it's a D in there, but it doesn't matter as much as most people think it does. From my perspective, when I look at people doing DCF, bankers, analysts, they spend way too much time on the D part and way too little time on the cash flow. If you're doing a healthy valuation, I want you to think about this when you do your valuation. You should be spending maybe 10 to 20% of your time coming up with the D. The bulk of your time should be coming up with the cash flows. But you know why people like the D? Because you can do what I call false precision, carry things to the third decimal point. Look, I've got this nailed down. The cash flows are terrifying, right? You got to think about business models and revenue growth and margins. But discount rates have to maintain those consistent. I've already given you one consistency rule. If you have equity cash flows, I said use the cost of equity for. We talked about the second decision rule. You tell me what currency you do the valuation in. Your cash flows have to be in the same currency. Brazilian real discount rate, Brazilian real cash flows. US dollar discount rate, US dollar cash flows. And if you choose to make your numbers real, I don't have a problem with that, but make sure you do it on both the cash flows and the discount rate. So let's break down where we're going with discount rates. So if you want to come up with a cost of equity, a risk-adjusted cost of equity, you have to start with a risk-free rate. There's no way you can do discounted cash flow valuation if you can't tell me what a risk-free rate is. And I'll talk about what goes into a risk-free rate, but yes, start. Then you got to come up with a measure of relative risk for your company. Is it riskier than average, safer than average? That's all a beta is, right? When you say the beta for a stock is 1.2, you're saying it's 1.2 times as risky as the average stock. And then you got to tell me what the price of risk looks like in the equity market. Again, I'm going to ask you a generic question. Don't think about the specifics. It's called an equity risk premium. Did the price of risk in the equity market do something today? Did it go up, down? Are you feeling a little more nervous today than you were if you're an investor than Friday? I think so. Equity risk premiums are reflections of all your hopes and fears, right? The COVID crisis hits, you get more scared. Your equity risk, the price of risk is a number that's dynamic. We'll talk about estimation processes, but that's what you're trying to estimate. So that's what you're trying to build into the discount rate. The risk-free rate, the relative risk measure, and equity risk premium. So let's talk a little bit about uncertainty, because we put it all into one bucket. But one of the things that can happen when you think about all uncertainty is you can get overwhelmed. I tell people to list out all the things that they're uncertain about with their company, just as a list. And when you look at the list, you say, oh my God, I can't deal with this. Because if you're honest, you take NVIDIA, think about all the things you're uncertain about, starting with, where did I say that chips were being made? Taiwan. And you then say, what if China decides to cross over into Taiwan? Well, there goes your TSMC part of the valuation, right? Think that won't happen? Well, that's got to be considered. So if you make a list and you see 37 items on the list, you say, I give up. It's too much uncertainty. So what I'd like you to think about are buckets into which you're going to put the different uncertainties. So here's the first bucketing scheme. Is your uncertainty that you're worried about estimation uncertainty, or is it economic uncertainty? Let's start with estimation. Let's start with the estimation uncertainty. Estimation uncertainty is, maybe I got this margin number wrong because I haven't. It's basically, getting the details right. Collecting more data will reduce estimation uncertainty. What's economic uncertainty? The China risk, the fact that DeepSeek could change the AI business. Economic uncertainty, you can do nothing about. What I'm preparing for you is for the moment when you're done with the evaluation. You're going to look at the value and say, I feel very uncertain. Then what are you trying to do next? Go collect more data, because that'll make my valuation more precise. You got to let go. There's a point where I call the karmic point, which is, I've done all I can. I've got to let go. Because economic uncertainty, you can do all the research you want, but guess what? Economic uncertainty is still going to be there. 90% of the uncertainty you face in most companies is economic uncertainty. Doing more research is not going to make it go away. Estimation uncertainty, economic uncertainty. That's for your sanity, because once you make that divide, you realize what you can change by doing more work and what you cannot. Second bucketing, micro uncertainty versus macro uncertainty. Take Tesla. What are the micro uncertainties? It's uncertainties related to the company, right? Basically, will their electric car get cheaper? Will they be able to compete with BYD? Who's actually running the company right now? So micro uncertainties, uncertainties relate to the company. What are macro uncertainties? What will inflation look like? Interest rates look like? What will government subsidies for electric cars look like? You're saying, why bother? You know the types of uncertainties that show up in your discount rate? If you're Fidelity, I said the risk you care about is the risk you cannot diversify away, risk added to a portfolio. The discount rate in valuation captures macro uncertainty, not micro uncertainty, because the micro uncertainties average out, right? For 100 companies, things got So micro versus macro. And there's a third classification that I find useful. Uncertainty can be either discrete or continuous. To give you a very simple example of risk where you can see the distinction. Until about 20 years ago, and there are still countries where this is true, used to have fixed exchange rate regimes and floating rate exchange rate regimes. So the dollar euro is a floating rate regime. What does that mean? Every moment of the day, the exchange rate changes. It's bad, right? Because it means your cash flows are changing as you go from one to the other. That's continuous uncertainty. Whereas if you are working with a currency where it's a fixed exchange rate, things look really stable, right? It's the same exchange rate every day until it isn't. Whether it's a devaluation or a revaluation, that's discrete uncertainty. Let me ask you a question. If you're running a business, you think it's easier to live with continuous risk or discrete risk? Continuous risk, I can offer you all kinds of tools. Discrete risk is incredibly problematic. Let's face it, in finance, we're very good at dealing with continuous risk. You know what we do with discrete risk? We act as if it's not there. Or we let the insurance company come in and deal with it, but what if it's not insurable? Discrete risk. So when you make a list of risks, so this of course needs you to pick a company and you start listing them, it's going to go into one of these buckets. So here are the broad themes that are going to drive how we think about risk. Not all risk matters. So when you look at a company like Tesla, you might worry about, the electric car model and whether but those are company specific risks. They will not show up in your discount rate. Doesn't mean they won't affect your cash flows, but they won't affect the discount rate. Second, when you look at risk, it's not what you see in the company, it's what Vanguard, it's very difficult to do because it's almost like you got to set yourself to the side and think about what would a diversified investor see in this company? Because you're a market price taker when it comes to risk premiums and cost of equity. And third, the reason that matters is if you look at most companies, and you're going to, and I'll give you a way of looking up the top 15 stockholders in your company. In most of your companies, those top stockholders are institutional investors who are diversified. And when you diversify, company specific or micro risk gets averaged out. It's not magic, it's the law of large numbers in statistics. Some companies do better than expected, others do worse than expected. So with that long lead in, I've led you into almost every finance class. If you take these, we'll spend weeks talking about risk and return models. I'm going to spend 3 minutes talking about them because this is not the purpose of my class. Ultimately, all risk and return models in finance make the assumptions I talked about, looking at risk through the eyes of a diversified investor. What they disagree on is how to measure the risk you cannot diversify away. The oldest risk and return model in finance is called the capital asset pricing model. It's been around since 1964. The developers of it, Bill Sharpe and John Linton, have both won Nobel Prizes. It's what you might have encountered in your work if you worked at a bank when you use a beta using the capital asset pricing model. And what do you need for it? A risk-free rate, a beta, and an equity risk premium, that number in the brackets. About 20, no, more than that, 46 years in 1978. An alternative came up to the capital asset pricing model called the arbitrage pricing model. Don't get caught up in basically what it does, take that one beta and allows you to have 4 or 5 betas, depending on how many sources of market risk there are. Still in the market risk dimension, so it's just an expanded version. You put names on the factors because the original arbitrage pricing model is a statistical model where the factors were factor 1, factor 2, factor 3. You name those factors into the yield curve or interest rate levels. You got a macro or a multi-factor model. Still doing the same thing. So the only difference, one beta, you have multiple betas. And in the late 80s, you had researchers for Chicago, Gene Farmer and Ken French, who said, why are we even trying to estimate the risk? Let's let the market tell us what's risky and what's safe. You see, how would the market tell us? They looked at 50 years of returns on stocks, and they looked at what stocks earned high returns. They found that small cap companies with low price to book ratios earn high returns. They said, that must mean they're riskier. You've given up on measuring risk. You essentially these are called proxy models for risk, but they're all trying to do the same thing. If you're doing a valuation, and let's say you use the CAPM, and there is this person on the other side, this is a pain in the neck, and he insists he wants to use a multi-factor model, you know what you should do? Just give it. It's not going to make much of a difference. This is not the fight you want to fight. It's not worth it because it doesn't make much of a difference, your ultimate value. I use the cap app and I use it with open eyes. I recognize the limitations. But if you push me on it, I'll say, you know what, I'll give up on it. I'll give you alternatives to even these risk and return models. Ultimately, I want a risk adjusted discount rate. So if you look at the capital asset pricing model, there are three items I need to get to an expected return. I need a risk-free rate in whatever currency you pick. That's what we're going to do for the rest of today. I need an equity risk premium for investing in equities as a class. And I need a beta or a relative risk measure. That's it, right? You know, when I did my MBA, 1979 through 81, you know how much time we spent on the risk-free rate? In 2 years, I spent 2 minutes on the risk-free rate. I was told to use the US Treasury rate, and we just moved on. Shows you how dollar-centric my MBA program was, and how much trust there was that if you bought a US Treasury, it was in fact risk-free. Those days are done. We're going to spend a lot more than 2 minutes because I want to talk about the risk-free rate. So let me define what I think of when I think about something being risk-free. First, if I have a truly risk-free investment, I should be able to tell you my expected return will always be my actual return. There's no variance around it. So let's play a game. Let's assume you have a 1-year time horizon and you buy a 1-year T-bill. And let's assume for the moment the US Treasury is default free. That's an assumption, right? It's not a given. 1 year from now, when I come and knock on your door, right now, 1-year T-bill is at 4.23%. You could buy it on the US Treasury auction. So I can put my money for 1 year at 4.23%. 1 year from now, when I cash out that investment, what's my actual return going to be? No, it's a 1-year T-bill. I know exactly what it'll be. It'll be 4.23%. Doesn't matter. It's a 1-year T-bill. It's done, right? It's principal being paid back. That's why I made it 1 year. If I bought a 10-year T-bond, you'd be right. A 1-year T-bill is risk-free with a 1-year time horizon. I'm glad you brought up the issue of price risk, because if I bought a 10-year T-bond, even if the Treasury is not default-free, then that investment is not risk-free. Why? Because then if interest rates move and the return on the bond changes, I'm going to have a return that's very different from my coupon rate. I need to know exactly what I will make with certainty. So here are the requirements for something to be risk-free. There can be no default risk, and there can be no reinvestment risk. If you have a 10-year time horizon, a 1-year T-bill is not risk-free. Why not? Because at the end of a year, you got to reinvest. At what rate? I have no idea. So when somebody asks, what's the risk-free rate? Before you answer, there are 2 questions you need to ask them. What's the first question? What time frame, right? And second, don't forget to ask what currency. Maybe they want a Venezuelan bolivar risk-free rate, in which case giving them a T-bond rate is completely meaningless. Well, there is no such thing as the risk-free rate. This will depend on currency and time frame. So time horizon matters. Currencies clearly matter. And not all government securities are necessarily going to give you risk-free. You know what the story is as to why government bonds are risk-free, right? Is it because governments are incredibly efficiently run entities? What's the power that governments have that makes them? They can print more money. You can try, but it's not legal, right? That's the argument for why. But it turns out to be a false argument, and I'll explain why. Because just because a government can print money doesn't mean it will. You know that half of all sovereign defaults in the last 50 years, sovereign defaults or governments defaulting, have been in local currency. So clearly governments default. There must be a reason. We'll talk about why it is that a government that could print off the money chooses not to, but not all government bonds are risk-free. So I'm going to take you through a series of exercises of 5, I think there are 5 tests. And by the end of the 5th test, you'll know everything you need to know about risk-free rates. Let's start with the first one. I'm valuing a US company in US dollars. I want a risk-free rate to use in my valuation. I'll give you the choices. I can use a 3-month T-bill, a 10-year T-bond, a 30-year T-bond, a TIPS. TIPS is actually a treasury bond, which is inflation protected, which means you know exactly what you will make in real terms, and then they'll pay the inflation on top of that. Maybe I should use the highest of these numbers because you're a conservative person. Or maybe the lowest of these numbers because you're a daring person. Or maybe it's none of the above, in which case I'd really like to know what your answer is because it's a fundamental choice I have to make. So let's start ruling what you don't want. Sophia, what should not be on that list? And tell me why the 3 months should not be on the list. For a company, right? Basically, it's almost never do you do valuation with the cash flow stop after 3 months. So because valuation inherently is a long-term exercise, a T-bill rate should never, ever, ever, ever be used as a risk-free rate in valuation. You might have learned otherwise in your foundations class, but maybe they were talking about risk-free over something that's much more short-term. What else should I knock off the list? They're the highest and lowest. So let's knock off A, E, and F. What about D? But in my analysis, I said cash flows forever in US dollars, right? The minute I say that, I've chosen a currency. So you're right. If I wanted to do things in real terms, I'd go with the tips rate. But since I'm not doing things in real terms, I'm going to cross out the tips as well, which leaves me with what? The 10-year or the 30-year. If I stayed pure, if I were a purist, and Sophia, I'm going to put it because you've reasoned your way to, if I were a purist, would I pick the 10 or the 30? Because how did you describe valuation? You're estimating cash flows forever. 30 is closer to forever than 10. Neither is that close, but let's face it. So if I were just picking a risk-free rate in US dollars, I'd pick the 30-year T-bond rate. If you go and look at every one of my valuations, I use the 10-year T-bond rate, and here's why. This is the start of the process, right? Once I get a risk-free rate, my equity risk premiums and default spreads have to be estimated relative to the risk-free rate. And it's a purely pragmatic effect. It's easier to estimate default spreads on a 10-year rate. And here's why. I have to find 10-year corporates to compare to the, I can't find 30-year corporates. So practically speaking, I use the 10-year T-bond rate. And my suggestion is whatever currency you're working in, you get to 10 years, the yield curve has already started to flatten out. Don't go looking for trouble. Say, I want a 30-year bond. I won't do valuation. Not a stand worth taking. I'm going to use the 10-year T-bond rate. But before I take the last step, I'm going to get down on my knees, look up at the skies and say, please God, let the US Treasury not default. We've had this dance. We got really close to the edge multiple times over the last decade because we have this debt limit. And every time we get close, there's will the US Treasury default. How many times have you read the story of next weekend the US government might shut down? That's an implicit assumption we're making. And we'll talk about what happens if I can't make that assumption anymore. So we use long-term rates. Everybody with me on that? Second stop. Let's suppose, how many, any of you valuing a European company in euros? We value
Siemens.
Siemens, and it's a German company. Anybody valuing any European company that's not in Germany? Sophia? Are you going to do your valuation in euros though? Okay, so let's pick somebody who's, anybody else who's valuing a European company in euros. I'm going to make you pick a Spanish company. Pick a Spanish company, doesn't even have to have a name, and you're going to do your valuation in euros. So both of you are valuing your company in euros. Both of you are going to look for risk-free rates. I'm going to help you out. I'm going to give you the government bond rate in euros and have a bit of a problem. You know why? There's not one 10-year government bond in euros. There are a dozen different governments that issue 10-year bonds in euros, and the rates are all different. So there's Spain and there's Germany. So let me start with them. You want a euro risk-free rate. Would you use the Spanish 10-year rate or the German rate? And that's the answer I get from most European analysts. But these are all 10-year bonds denominated in euros, right? This is not 1999. We're talking about pesos and drachmas and French francs. And they're all euro bonds. So why are the rates different across? Default risk, right? And already you see the problem with picking the Spanish government bond. I wanted you to pick a risk-free rate, and you picked a rate which has default risk in it. So I'm going to give you a second shot. So which of the rates are you going to pick? And why? It's the lowest. It's not because it's German. The German has been the lowest 10-year euro bond rate for as long as I remember, but it's getting awfully close. Germany's having its own set of budget and economic problems. The Dutch rate is actually getting really close. And who knows, next year when I do this, it might be it's not because it's German, but because it's the lowest. You value any company in euros anywhere in the world, you're going to use the German. Part of you saying, but what if it's a Greek company? I want to punish the company for being Greek. This is not the place to do it. I will give you plenty of chances later on to revisit that issue. This is the risk-free rate. Same thing with a Russian company. Now, Sophia can choose to value a Russian company and do it in euros, and she's going to use the German euro bond rate. So, but what about the risk in Russia? What are the two other inputs waiting for me? An equity risk premium. No, even in the discount rate. Wait. I'll give you a chance when you get, especially the equity risk premium, when you do risk-free rates in euros, you're going to go with the German euro bond rate, but be very specific. It's because it's the lowest rate. In fact, there are people who even suggest that maybe I should go with the European Central Bank rate, because even the Germans don't control their own money supply, because once you picked a common currency, that's what you give up. So if you want to use a European Central Bank rate, it's actually very close to the German bond rate. You could use that instead, but that's euro. Let's climb one step further up the difficulty ladder. It's January 2025. Anybody valuing an Indian company in rupees? Okay, who are you valuing? Azara Technologies. Okay, so you want an Indian rupee risk-free rate. So first you're going to go look for an Indian government bond, 10-year government bond in rupees. You can find one. That didn't used to be the case. The rate at the start of January 2025 was 6.82%. I'm done. Risk-free rate. But before you go and use that as your risk-free rate, what do you have to check? Is there default risk in there? I'm going to help you along the way. If any of you have visited the Moody's or the S&P website, there's a section of the website for sovereign ratings. Basically, Moody's and S&P and Fitch all rate countries, not companies, countries. And they give two ratings for every country, a local currency rating and a foreign currency rating. What's a foreign currency rating for India? It measures the default risk in India if it borrows money in euros or dollars or yen. The local currency rating, at least in theory, is the risk that Moody's sees in India if it borrows money in rupees. As you check that rating, what you're hoping and pray, what will make your life easy? See a AAA rating, because then if something goes wrong, you can blame Moody's. At the start of 2025, the rating for India was Baa3. What does that tell you? That 6.82% is not quite risk-free. There's some default risk. So think of this as an algebra problem. If you can just figure out what that default risk is and take it out, make it risk-free, right? I'll help you along the way, and I'll come back and flesh this out later this week. The default spread for a Baa3 rated country in January 2025 was 2.18%. So can you bring those two pieces of information together with the risk-free rate? Yeah. You're trying to reason it out in open space is what you're trying to do. Yeah, exactly. That's exactly what it is. The 6.82% is default spread. So let's reason it out. So 2.18% is a default spread. So what are you going to do? Take it out or add it back? You got a 50-50 shot. Take it out, right? Don't add it back. That'll be double counting. You take it out. My risk-free rate in Indian rupees is 4.64%. Little more work, not there. You're saying, can I do this with Russian rubles? Well, there's a problem. You know what the problem is? 2 years ago, the ratings agencies stopped rating Russia. Until 2 years ago, you could have done this with rubles as well. I used to do this when I valued companies in rubles. We'll talk about what to do when countries are no longer rated, but for countries that are rated, you can start with the government bond rate. So this default spread number becomes a number you got to estimate. I'll give you three pathways you can use to get the default spread for a country. Much of Latin America, Brazil, Peru, Chile, the government issues bonds in US dollars as well as in the local currency. So Brazil has a 10-year dollar bond out there. Right now, let's say the Brazilian dollar bond is at 4.5%. Let's say it's at 6.5%. The T bond is at 4.5%. That difference is a default spread. You can do this only if they're in the same currency. Some European governments issue bonds in euros. You can compare that to the German euro bond. That spread is a default spread. That's the first approach. The second is a market that is of fairly recent origin. It's called the sovereign CDS market. Sovereign CDS market is a market where investors assess the risk of a country and they come. It's a market set number. So you can't blame S&P and Moody's for this. This basically is what market demand and supply say. It's a market estimate of the default spread. It's all more updated, but it's also going to be more volatile. Markets are. So for countries which have a rate, which have a sovereign CDS spread or dollar-denominated bonds, I can use it. What if you don't have both, and all you have is a rating? I have a lookup table that I've created that I use existing bonds, and at the start of every year I update this. So you tell me what your rating is for a country, I'll tell you what the default spread is. That's a 2.18%. Which is the best one? There is no best one. There's really what works for you. But as long as you stay consistent, you're going to be okay. But that's basically it. So I'm going to close off today with what those three numbers look like for Brazil at the start of 2025. First one is government bond rate, 7.75%, 10-year government bond in dollars. 4.58% was the UST bond rate. The difference, 3.17%, is my default spread for Brazil. Works because they both have dollar bonds. Sovereign CDS market, 3.23% market set number. I net out the default spread for the US because some of that default spread is really not for defaults for the fact that the market is structural. But either way, you're getting a market measure. A little different from the bond market. And finally, you give me the rating for Brazil. I think the actual rating is BAA is you end up with 2.83%. Three different default spreads. So the start of the next class, we're going to start with those three default spreads and work them through to come up with risk-free rates in real. So I'll see you on Wednesday.
How do you reconcile the fact that discount rates are different for different currencies? Valuation.
Inflation.
Inflation would account.
That's it. That's the only thing.